low-cost indexation is a hot topic at the moment, with government actively looking to tackle asset manager fees, which eat into longer-term returns for savers. Now, the debate is rapidly moving beyond the simple question of whether index tracking products are cheaper, but it is now looking at the entire value chain, that's including platform operators, to bring these costs down. Finweek tries to ascertain where the costs lie and what steps can be taken to reduce them and make it more attractive for investors to save. For more on this, Jessica Hubbard from Finweek and Nerina Visser, Head of Beta Solutions at Nedbank Capital. Thanks so much for joining us, Nerina. So when we talk about low-cost products, typically what type of products are we talking about?
I think it's immediately associated with not necessarily just index tracking, but maybe any passively managed product. And although ETFs are known to be index tracking products, we must also remember that index tracking does not only come in the guise of ETFs, but also you can find an index tracking unit trust, and of course within the institutional space, index tracking segregated mandates. So those would probably some of your lowest cost, just if you're looking at the cost of the product itself. But that's not the only cost that is associated with investing, and I think that's exactly what government is trying to get at, is that we like to think in terms of three types of costs associated with it. There's the product cost. Then there would be the cost of acquiring the product or distributing the product, and I think that's where the platforms come in, or your stockbroking charges, or those sort of things. And then the third type of cost is your advisor fee, or in the institutional and maybe in the retirement fund space, your consulting fee. Really the advice component that says which is the appropriate product. And the advice which is given should be completely independent of the product that is chosen and completely independent of the distribution platform or the distribution means that is used.
But it's not at the moment.
It isn't at the moment, and I think that is certainly one of the things that we are already seeing this changing internationally, and I think one of the things that government really would like to see changing in South Africa as well. It really is the shift from going from a fee-based income basis for advisors to an income-based or an advice-based fee. Really.
So performance-based?
No, not performance-based at all. It really is saying that being a financial advisor means that you're offering a professional service, just like a doctor or a lawyer or a car mechanic is doing, and that the user should be, or the client should be, paying for the professional service that is being rendered and not being paid via a commission of the product. I could equate it basically to saying that the drug company of the medicine that the doctor prescribes to you is supposed to refund the doctor for the medical services rendered.
So depending on what type of medicine you buy, depends on how much you pay the doctor. And that of course doesn't make any sense.
Exactly.
But the problem seems to be that clients of financial advisors don't know that the costs aren't separated, that they aren't, those fees aren't put up front.
Yeah, I think as much as one tries to be transparent in these costs, they are not comparable on a like-for-like basis. Because I think what you find is the most common distribution platform for retail investors in particular would be your list platforms, your linked investment service provider platforms, and each one of these have got their own way of breaking down the costs, and they would all say that they are extremely transparent and that they're doing it exactly according to the book. But the problem is that they're not comparable, so it becomes very difficult for an individual user to do a comparison of these costs. Maybe not too dissimilar from bank charges. We all know how difficult it is to really do a fair comparison. Also because it really does depend on who you are and what are your unique requirements. Do you want to run a debit order? Are you a small regular investor or a once-off lump sum investor? Because all of these things impact the overall level of costs that would be associated with your investments.
Well, we've got Stephen Nathan, Chief Executive at 10X Investments, standing by from our Cape Town studios to give us his views on the issues around cost. Stephen, thanks for joining us. So Nerina talking about three costs here: product cost, the cost of acquiring the product, that of course includes the platform, brokerage fees, etc. And then of course the advice aspect, the advice, financial aspect advice. Where do you see the opportunities to bring down costs quite considerably in South Africa? Where's the obvious space right now where costs are just too high?
Well, I think it's the issue is the aggregate cost you're paying for your product and your service. So if you go back to basics, people have an investment need and they want solutions and not products. And the more choices and options you give them, then the more you disempower people because they don't understand them. They need advice, and then that advice, as Treasury has said, is often conflicted, and advisors tend to steer you in products that have the highest margins. So you can either work it from two ways. The one is you can say, well, the industry needs needs to provide more simple solutions to clients, or the other way is for the clients to be able to be self-directed and empowered to make their own decisions. And I think both of those are big asks, and really what Treasury is saying is that we need to get more involved to bring the two closer together, because we haven't seen any improvement from the industry in aggregate, and Treasury has been talking about these issues for more than 10 years now.
Mm-hmm. So then, I mean, where are we when it comes to regulating this? I mean, are we ever going to get to a situation in South Africa where in fact they're, kind of penalized if they don't? I mean, what is the option here when it comes to regulation?
Well, I think that we hope the regulator will step up to the plate. I mean, Treasury last month put out some hard-hitting papers, and they identified several poor industry practices as impediments to people achieving adequate income in retirement. And they spoke about lots of investment choice, the complexity of that choice, the conflicted advice that goes with the choice. And when they looked at the portfolios, people had very similar portfolios despite all the complexity and the choice and the fees that they were incurring. So Treasury is saying we need simplified products, solution orientated, much lower fees and more transparency. Now, a lot of people, and Nerina mentioned this, there is a feeling that disclosures improved dramatically. We at 10X don't see that. I've seen lots of quotes for big pension funds that don't disclose all the fees. So a lot of the issues that Treasury has highlighted actually are phase issues. And phase is a regulation that is there to protect investors, to ensure that they get unbiased advice, so they get appropriate advice. There's fee disclosure, they understand fees, and also importantly, not only do you understand what a 3% fee means, but it's fees in the context, because a 3% fee sounds innocuous, but when you compare that to a long-run real return, the return you should expect after inflation is only about 5%. So 3% in fees is not 3%, it's actually 60% of your real return, and over time that compounds to erode 75% of your long-term wealth.
So of course Treasury's come out with this paper, they've highlighted the issues, they've been talking about this for 10 years, as Stephen says. What are your views on the solution to the problem?
I think it talks very clearly towards the low-cost product which is offered by index tracking solutions. So in terms of product cost, I don't think there's much fat left in the system. There wasn't a lot of fat to start off with. These are your low-cost product solutions, so I don't think there's a lot that can be done in that end. I think the real difference can still be made in the distribution channel, and in terms of how they are acquired, and in terms of the advice as well. And I think it's not just related to the investment industry, but even if you look at things like if somebody wants to save through a debit order, for example, in some instances you might find that the debit order might run at R3.50 for a debit order. If you're only saving R100 a month, that's 3.5% of your monthly investment that goes towards just the debit order. It's got nothing to do with your investment. So I think there are hard questions to be asked of everybody in the value chain, and every single component of the value chain needs to assess and be able to justify the role that they play, and that the fee that they earn from it is justified within the context.
Yeah, I mean, but you just talk about debit orders. I mean, I don't think the banks are going to stop that.
No, but I think what it does mean is, and Stephen has certainly pointed out to it also, is that there are ways in which one can facilitate bulking maybe. Even if you do it, for example, through a corporate payroll, and I think this is exactly where government is also looking towards savings towards retirement to become a different specimen or a different model that we need to look at. So one needs to differentiate between compulsory money and voluntary money. So compulsory would relate to your retirement savings, and if you are part of in the formal employment, there would be some sort of formal retirement funding that you're familiar with. But if you're not, then how do you save towards your own retirement? But even then, within the voluntary funding space, it's also a case of how do you actually maximize the investment and the savings component of the little bit of money that you do have available. We're a saving short country, and how do you actually encourage that? Certainly not by running a debit order where your debit order actually ekes away.
There has to be an incentive, and for those clever people who do realize that after inflation they're not getting a lot back, you need to create a better incentive.
Definitely.
Stephen, what are your thoughts on the cost of trading on the JSE relative to other international stock exchanges?
I don't have a particular view on that, but I think let's look at cost. You basically have three services that you pay for. The first, you pay for advice, and advice can run up to 1% of your investment balance. Secondly, you pay for administration, including the investment administration, the so-called list platforms. There, once again, you can pay up to 1%. And then investors, retail investors, unit trusts, you typically have an expense ratio of 1.5% to 2%, and you may pay performance fees. So if we simply say that you've got potentially up to 4% in costs, 1% advice, 1% for the administration, up to 2% for the investments, then you've got to say, well, am I getting value and can I do it better? Now, often advice is not really advice, because as Treasury has pointed out, people are being advised to invest in the wrong product. So advice can't be working. So it's really, often advice is a marketing cost, so it's a distribution cost. So we can definitely cut advice costs very significantly. The platform fees, the administration, that also should be cut dramatically, because it should be embedded in actually managing someone's investment. You shouldn't charge twice for what is really one service. And then the investments, as Nerina has said, there, rather than paying 1.5%, 2% for active management, you can get portfolios with the exact same risk profile for 0.5% or maybe slightly more. But certainly the research is showing you that on average, an index fund outperforms an active management fund. So if you look at those 3 layers of fees, there's a tremendous amount of fat, and there's a tremendous amount of efficiencies that can be brought to for the investor that can deliver the same, if not better, products at substantially lower fee.
Stephen, this is Jessica from Finweek here. It seems like a lot of responsibility is actually falling at the door of the financial advisors. They are not disclosing what their advice is actually costing, and it seems like a lot of it isn't actually necessary. So doesn't the financial services and the financial advisors, don't they need to take more responsibility and get more involved here?
Well, I think that it's difficult when you incentivize in a certain way. It's very difficult to change your behavior, because incentives do tend to drive behavior. I would rather look at the product providers. I mean, we have, you've got 5 or maybe even 10 large product providers. So these are companies, live companies, etc., that are manufacturing the products. If they manufacture good products, then it's going to help the whole value chain, because then the advisor can only sell a good product. But at the moment, they're manufacturing hundreds, if not thousands, of different products. Some are good and some are really bad, and no one really knows the difference. And that's, that creates a lot of conflict within the system. The advisor's stuck in a. It's very difficult. If you were to say to any advisor, well, we can actually do a much better job. We can replace you with technology, with the internet, with simple solutions. Clearly, they're not going to want that, because they're going to be at risk. So I wouldn't really look for the advisor to solve the issue. I think the regulator needs to regulate FAIS, and FAIS is all about ensuring that advisors do the right thing and customers are informed, they make informed decisions. The only way you can make an informed decisions if you have the facts. So you mentioned advisor
Stephen,
fees
we're going to
not
have to
being
leave
disclosed,
it there.
But I've seen large company, their administration fees not disclosed, their investment fees not disclosed. So I wouldn't really point a finger at the advisor only.